Let's talk about Tesla. Okay, what was it? More than 2 years ago, you're at Zone. You pitched the converts.
Converts, yeah.
Where are you with those today? And then I want to talk to you more broadly about that company.
So if you take a step back, right? If I asked you to sort of, attempt to drive a golf ball off the pier here into a teacup and gave you 1 million tries, I suspect that in 1 million times you would not be able to do it. But if you then took somebody else and they were able to do it 9 times out of 10, you'd say, wow, that person is a great golfer. The analogy that I would make is Elon basically did that equivalent. He was able to send a rocket into space, do all kinds of interesting, enormously productive, useful things for the world while in space, and then come back down and land on a boat in the middle of the ocean. The kind of technical sophistication that he has in his mind, that he's been able to apply across his companies, is second to none, quite honestly. So when we looked at Tesla, what we thought was a company at an inflection point that was as close to its version of an iPhone moment. And what I mean by that is a company that had been growing up, taking risks, and had finally found the mass market product that would unlock an enormous amount of product market fit. And that was the Model 3. And so far, what I would say is he's living up to what he has signed up for, which is to commercialize electrification, to commercialize an incredible user experience at a price point that has frankly cannibalized its competitors. And what you see in the results, in my opinion, is a company that is now maturing under all of that demand. And so, again, is it the best suited company if you want to drive and observe quarter over quarter precision and performance? No. But if you want to take a step back and take a 3-5 year view and say, where can I compound my money? And particularly with the converts, what's so beautiful is it's downside protected because it sits on top of all the equity and the other debt. And so if you have any concern that there's liquidity issues, or if you have any concerns that the company may have to sell, they get paid first. So to me, it was a riskless option on the Edison of our generation.
But you weren't you weren't necessarily comfortable enough with the story to buy the common stock?
The reason is because the common stock is not controlled, unfortunately, enough by him or the insiders. What it's controlled by are a bunch of vulture-like venture and hedge funds, mostly hedge funds, who like to prey on that company. If you look at, for example, the Twitter traffic, or if you look at the forum traffic around Tesla, the amount of hyping or under-hyping, the amount of sniping is enormous. All of that signals to me that it is a market that is out of the control of the founders and the executives and firmly in the hands of financial manipulators.
Well, come on,
so
I mean,
my perspective is buy the bonds, you're protected, and allow Elon to execute.
Isn't the founder and his actions responsible for a lot of what you're talking about?
Well, all I see, frankly, is that he has tried to execute to the best of his abilities. He puts out aggressive numbers. He tries to meet those numbers. Sometimes he misses those numbers. What would you rather
often he misses the numbers.
But that's okay, because in the course of the year or in the course of the 5 years, if you take a 5-year step back and say, what has he promised in 2014 to what is he doing in 2019, you'd be ecstatic. Similarly, if you take a step back and say from 2019 to 2024, let the man do his job, will we be better or worse off as a planet, as a species, as humanity, as consumers? We will be better off.
And no one debates his genius. It's lauded, celebrated.
Tesla stock closed at $177 in the latest trading session, marking a 1.2% move from the prior day. The stock outpaced the S&P 500's daily gain of 1%. And on the other hand, the Dow registered a gain of 0.34%, and the electric car maker stock has dropped 5.89% so far in the month, falling short of the auto tires truck sector's gain of 3.6% and the S&P 500's gain of 3%. And analysts and investors alike will all be keeping a close eye on the performance of Tesla in its upcoming earnings disclosure. The company is expected to report EPS of $0.67, down 21.18% from the prior year quarter. And meanwhile, our latest consensus estimate is calling for revenue of $25.8 billion, up 11% from the prior year quarter. And for the full year, the Zacks consensus estimate projects earnings of $3.16 per share and a revenue of $112 billion, demonstrating changes of 1.28% and 15.69% respectively from the preceding year. It is also very important to note that the recent changes to analyst estimates for Tesla, and these revisions help to show the ever-changing nature of near-term business trends, and consequently, upward revisions in estimates express analyst positivity towards the company's business operations and its ability to generate profits. And our research shows that these estimates changes are directly correlated with near-term stock prices. Investors can capitalize on this. And looking at valuation, Tesla is presently trading at a forward price to earnings ratio of 56. This expresses a premium compared to the average forward P/E ratio of 14.26 of its industry. Investors should also note that Tesla has a PEG ratio of 2.5 right now. This metric is used similarly to the famous P/E ratio, but the PEG ratio also takes into account the stock's expected earnings growth rate. And by the end of yesterday's trading, the automotive domestic industry had an average PEG ratio of 1.81, while Tesla has an average PEG ratio of 2.5 right now. And shares of Tesla have fallen over 27% year to date, with fellow Magnificent Seven companies, Apple, Alphabet, Google also lagging behind the rest of the group. So are these companies doomed to fall from the pack, or does the dip represent a buying opportunity?
The fact that the way he runs his company, you're comfortable with that? If you're an investor in Tesla, you're 100% comfortable with the way he is a CEO?
Yeah.
None of the actions that he's done over the last year or so give you pause at all?
What do you mean? Meaning the Model 3 is an incredible car. I just bought one. It's incredible. I bought it the way that it was
secured? I mean, what was that?
Okay, maybe he stepped out of bounds. My point is, you're getting caught up in the window dressing. I'm focusing on the main course. The main course is on the table. The choice for you as a buyer or a seller of that stock is, do you want to eat it? If you get caught up in all of the stuff around the edges, maybe he may mistweet from time to time. My point is, who cares? Your job as a smart investor is to separate the facts and the news from the fiction and the noise. And all of that stuff doesn't matter. It does not change the fact that tens of thousands of consumers are buying that car faster than they can get their hands on it. It doesn't change that the minute you sit inside that car, your definition of what is expected is altered forever. And you wonder why every other car around you that you ever step in, that you may buy, doesn't have the same things that that car offers. So at the end of the day, whether you like his style or not, his substance is irrefutable.
Sure, but I walked down the street here in San Francisco the other day. I see a billboard for the new Audi electric car that's coming. I mean, competition is coming. If it's not already here, that gives you no pause?
You're right, because I remember all the Zune media players I bought after Apple released the iPod. I also remember the enormous number of amazing smartphones I bought when the iPhone was launched. It's not what people do. You know, it tends to be the case that when you redefine expectations and you have a category leader and you have an indelible brand and a mark that people recognize, the easiest decision, let me be a little pejorative, the lazy decision is to pick the winner and go with it. And in this case, there is a clear winner in electrification. It is done. That die has been cast. And so now the question is, can he build the infrastructure to deliver the demand? And if given time and if given patience, I believe he will, and I vote with my money that he can do that. And everybody that bets against him can do that as well, but at what stake, really? Because it's not as if there's no downside protection for the stock. The people who short this company are so short-sighted because the number of companies that would come out of the woodwork, you don't think that Apple, with $200 billion of cash, backstops this company and has a chance to enter a $1 trillion market overnight by buying that business if it gets imperiled in any way? Google, which already tried to buy it, wouldn't try to buy it again?
I'd say it's a risk.
So what are we betting against? We're betting against a cleaner earth because we don't like that. We like to suck in the carbon monoxide and the fumes from all these cars. We're betting against beautiful flat screens, beautiful ways in which to manage your experience inside the car because we don't like that.
No, we're betting
Why?
against whether he can deliver what he says, the fundamentals of the company. That's what they're betting against.
No, that's not true. People are betting against his style. They don't like his style.
It's not just that.
It is
come on,
just
there's smart people like Jim Chanos. He's a smart investor. He's not betting just on his style.
Jim Chanos makes money once a decade. And while the market rips up, the guy just bleeds money and he's never on CNBC. And every time something works, he's there for 5 minutes. Great for Jim Chanos. Fantastic as a hedge in a portfolio where you have 1% in a short fund. But the reality is being long equities makes sense. Being long innovation makes sense. Betting against entrepreneurs that are changing the world has never been a profitable endeavor. Why start now?
An analyst notes that for Tesla stock to experience a turnaround, several developments must emerge from the automaker's records research and development spending. And first, the next generation vehicle has to start to ramp up production, or people have to gain confidence that's going to ramp and be successful. And secondly, their margins need to go up. The most likely lever for that happening is the increase of full self-driving penetration, which leverages the AI they built, in addition to volume starting to pick up. Third is continuation in growth, really good growth in their energy storage business. Tesla is a Magnificent Seven's biggest lagging stock year to date, but it's not the only one. Shares of Apple and Alphabet are also in the red since the start of the year. And now this week we are focusing on these three stocks which are lagging and what is going to take for these companies to turn around. And today the focus is Tesla, currently trading at just around $176 per share, a loss of nearly 30% this year alone. But does that mean that it is a good buying opportunity? Now, to understand why Tesla stock is lagging, I mean, it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 months, they've been terrible. I mean, I think we started for 2023 somewhere early that year on $6 and it came all the way down to $3. And I think we are at a period of time right now where the worries likely exceeds the reality. And we have had some numbers last week come out of China that were not really good, but people didn't take into account that the new year has pushed into Feb, and also some stuff that happened in Germany. That plant came down for about a week because of arson, a week plus. And in the US, people are worried about the production of the new Model 3. And we think that the best way to kind of gauge for the most part of what's happening in Tesla, particularly in the US, is to look at their prices. And they've been pretty stable in the US over the last couple of few months. So there's a lot of wood to chop still in the quarter. But in the near term, we think that we may have overcorrected here to the downside, is what an analyst thinks. And they talked on their most recent earnings call about the spending of some of their record research and development that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and the years following now. And how much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we have seen some early slippage this year, at least in the price action. And now look, we're in a little bit of a pause period right now for the stock, and in the near term wiggles, we think we have overcorrected. But for the stock to really get its legs, we have to have three things happen. And firstly, the next generation vehicle has to start to ramp up, or people have to gain confidence that it is going to ramp and be successful. And secondly, their margins need to go up, and the most likely lever for that happening is the increase of full self-driving cars. So when you talk about leveraging this research and development that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, the next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly related to the cost of the vehicle. We think the company should cut the price of the FSD to really increase penetration and really have the margins start to turn in. And if you think about it, that offering is about 100% gross margin, very, very high gross margin, because it is a software update. And now with a lot of price wars going on in the EV market, obviously Tesla, far from the only automaker, one of many I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see the more broadly speaking beyond Tesla shaking out just a bit, and that pressure to the downside in terms of boosting demand, how much longer are they going to be forced to prices in order to drive the demand that we simply have not seen? And to this, George replied, the analyst, well look, there's been a pause like I said recently, particularly in the US. The price declines that we saw for the most part in 2023 is sort of a bed right now, which for us is an indication that maybe things are not that bad. And what the company did strategically by being aggressive is, first of all, they got to sell more vehicles, right? Because interest rates went up and most people financed the purchase of their vehicles. So that means the prices of vehicles went up artificially. But second, it put a lot of their competition on their back legs, because if Tesla is one of the most profitable automobile company, especially in the EV segment, and if Tesla's margins are going down, just imagine what's happening to their competitions who are selling at a discount. And I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is to put a lot of its competition on the back foot, particularly in the US and Europe. And so talking about China, because that's one of the largest kind of lingering risk right now for Tesla, is sentiment shifting so much in the region that there would be a longer term implications for how Tesla is able to operate and sell into China as well. And to this, the analyst replied that we see the real competition for Tesla long term, like we really like Rivian in the United States and in parts of Europe and other parts of North America, but in China specifically, there are some very good OEMs competitors from pure play EV companies. And the company has one plant in China right now able to produce about 950,000 vehicles, and they're running, despite this monthly volatility, they're running at full tilt there, and we continue to believe they'll run full tilt in that country. So there's really good competition in China, but we think Tesla can operate that factory at relatively full capacity. That leaves them in a good place in that country. So that's it guys from here today. Thank you so much for watching. Please hit the like button and do subscribe. I hope you all have a good day.